All right, welcome to our show. It is the trading day of the 13th of April, and we're going to see how we did over the long weekend. You've opened your app? No, right? You haven't looked? Okay, I looked this time.
Okay.
Can I give a prediction?
You want to predict?
I
Go
want,
ahead.
for you, I think you're going to be quite happy about
Oh,
where
really?
things are at. So let's try it out. Okay, let's look at yours first, and then we'll look at mine.
Oh man, don't jinx me. Oh, wait, no. Why don't you go first, and then I'll open mine?
Why?
Because I went first last time.
Okay. And I mean, I already know what has happened, but I think that you will enjoy this because I'm really doing all I can. Oh, you can't see
Oh
it
no.
with the green screen.
Let's get rid of the background. Let's get rid of the background.
No, it's okay. I'll just tell you.
I can
I'll
see.
tell you what I'm at.
Okay, what?
I am at $787.
What?
Yes, amazing. So
Wait,
I
all
have
those calls and stuff?
I have lots to talk about today. We're going to have a little discussion about how this happens. So
Okay.
I think we should deep dive into what's going on as well. But that's where I'm
You
at.
want to see, man?
787. Yeah, let's see where you're at.
In 3.631.
Very nice. 3,000. Wait, what? 3,631?
Yep. Zoom did very well. Zoom offset a lot of the other stuff.
Exactly. Yeah, so I saw Zoom skyrocketing yesterday, so I knew that you would do well because it's about 40% of your entire portfolio at the beginning, right?
Yeah.
And now it's about probably 90% of your portfolio.
Yeah. Pretty much.
So it's doing very
That's
well.
great.
And I think that as
It's
long
not
as
as fun to gloat when your competitor is 794. And you can really make that video about 90% now.
yes, I can.
Okay, let's
92% down. Yes.
90% down.
Oh, brutal.
You didn't have to go 93. You could have stopped at 90%. See,
I know.
very-
It's just really hard to time it, you know. I couldn't quite get it perfect. Oh man, yeah, that was brutal to see. It was brutal to watch it happen because I watched it over like the first couple of hours of the day. I have some theories and I've been doing some reading over the weekend.
Okay.
And so we can jump into that. So what I think is happening is a couple different things. One, I'm getting crushed by Theta, right? The time value of these options is going down. So what I did is I bought these calls to kind of offset my puts, which was I had some puts for 417, I had some calls for 417, but I bought these puts quite some time ago. And so they're really out of the money. So even when the market is moving towards the put value, they're still so far out of the money that the options are not worth very much. And this is because of the implied volatility. Because the volatility of the entire market is going down right now, right? There was a huge spike in volatility a couple of days. And that was like such a crazy drop all at once that the volatility spiked up hugely high for almost all companies. But now it's coming down. So the likelihood that it'll get near one of my puts is now getting less and less, because not only is time like kind of collapsing in, but also the likelihood is also going down. So even though the market price for the underlying security is going down and getting closer to my puts, I don't have much time and the volatility is going down. And so actually my puts are also decreasing in value, even though the market decreased yesterday. And then as well, on the call side, I also did calls for kind of out of the money as well. Like for instance, SPY 299, and we're at like 275 right now or something. So the likelihood that it will get to 299 is also relatively low because of such decreased volatility. So both my calls are going down and my puts are going down no matter which way the market moves because the volatility is so low. And I only started to understand this over the weekend as I started reading more about volatility, how it affects options. and also the time decay of options. This is why the entire value of everything I have is going down. So all of my positions are basically wrong right now. Like, they're super out of the money, and the likelihood that they will get in the money is really low now. Even my puts in May are like SPY 215 or SPY 200 puts. And without volatility, in another month, is the likelihood that it'll get there is just almost zero. So those puts are going to be worthless. Even if we start to go down slowly, we won't get close to where those puts are going to be in the money. And so the value of them is going to continue to decrease. Really fascinating stuff. It's a really interesting learning experience. I wish I'd known more about this before we started playing.
That's the way to learn is to get burned, right?
Yeah, the best way to learn is to get burned. That's a really great quote.
Easier to say when you're not in the process of getting burned.
Yes.
Okay, what are your expiry? I'm just curious in terms of expiry dates. I mean, some of your calls are they quite far out that you have enough time for them to come back?
They're not very far out. I match them to my puts. So most of them are 417 or 420.
Oh, interesting. That's so interesting. Why didn't you buy, I know it's always like, I'm really fascinated. Why didn't you buy calls that were further out?
Because they were too expensive. So I wouldn't have been able to match any of the positions in my portfolio. As in, if I had like puts on Uber and Starbucks and SPY, and if I wanted to buy calls on Starbucks, SPY, and Uber, then I was not able to buy at a further date for calls because I didn't have any money.
I see.
So I think I made a bad move there. And actually last week I also said this. I'm like, I think I might have done something stupid. And they raised in value for 1 day-ish, but now they're, even if the market goes up, I think that the value of these options will go down unless they get close to being in the money.
I see.
And this is what we saw with that one call that I did last week, which was I bought it and it went into the money, and then it was worth 200%, but only because it crossed over that threshold.
Yeah. I don't have too much to say about mine except that
you're really glad that you bought Zoom.
Yeah, I'm very glad. All my SPY puts are worthless.
When do they expire? When do most of them expire, and how much are they for?
Well, I don't have too many. I sold off most of them, but basically I have 2 SPY puts that are expiring this next week, Monday. The 200 and 220, you know about those. I've already shaved off like half of them. I sold half of them, so I'm not holding too many now. I'm still actually very heavy on puts, funny enough. And really the only thing that's going in my favor is that call on Zoom that I did. But I have that space put, which I bought, the put on space that I bought on Friday for $13, expiring June 19th. That is the newest one that I got. And let me just see. Yeah, it hasn't really changed much. I mean, my average price was like $199, and it's $2 right now. So it really hasn't moved.
That's your Zoom call.
The Zoom, no, that's the space put.
Oh, the space put. Okay, so the value of that is still close to what you bought it for.
It's close. It's strange. I don't know. I need to understand this app a little better. Like, I know I bought it for $199, and right now it says $2. So I'm not sure why it's showing that I have a loss on it, but we'll see. And the Zoom has, I'm grateful for Zoom. It's I bought it at $23, so now it's at 13.8. So it plummeted for sure.
Yeah.
And now it seems to be on its way up. And this expires in August. So I think that this is one of those things I'll just like keep. Not going to touch.
Yeah.
I hope that I can. My only concern right now is liquidity. I have most of my cash stuck in the Zoom call.
Yeah.
My hands are tied. There's not too much I can do.
So what are you going to do today, if anything?
So I thought that in the interest of learning new stuff and like sharing some moves with our little broadcasts every day, I'm gonna try what's called a put credit spread.
Okay.
Did you read about vertical spreads over the weekend?
A tiny bit. I came across the term, but I still don't really understand it. Can you explain it?
Okay. Yeah, of course. So there's two ways of playing with options. I mean, there's 1,000 ways of playing with options. But basically, there's what we do, which is called a single move, a single leg strategy, and there's like a multiple leg strategy. And I think one of the most commonly used multiple leg strategies is when you say, what you do is that let's say we want to play with calls. We will buy a call and sell a call at the same time.
Okay.
And when you do that, you have a high probability of profit,
Right.
and you have defined loss.
Right.
So the math is interesting. I mean, the gains are not nearly as exciting as like what we can do with like just single options and stuff. But I thought I would try that out. So how it works, I don't have a chart with me right now, but let's see whether, you're really good at this stuff. So basically, you can either do a call credit spread or a put credit spread. Now you buy a call credit spread if you're bearish. And the other way around, you would buy a put credit spread if you're bullish. So I'm actually bullish. I'm terrified actually of my puts that I'm holding. So right now, right, like I have this, let's just talk about the space put that I bought that is expiring June 19th, right?
Yeah.
At a strike price of 13. Actually, as I'm describing it to you, I'm working on my head. But in general, the lower a put is in strike price, the cheaper it is.
Right.
Right. The higher it is in strike price, the more expensive it is.
Right.
So what I'm going to do is just putting random numbers. I don't know whether I'm actually going to do this, but like what I might do is that I might sell a space put at say $14, right?
Right.
So I bought a space put at 13 and I'm going to sell the space put at 14.
Right.
What happens is that my profit would be the premium I receive from selling the space put at 14.
Yes.
Minus the premium I paid to buy the space put at 13.
Got it.
Because it's always cheaper. Puts, right? Puts at a lower strike price are cheaper than puts at a higher strike price.
Yes.
So that is my profit.
Got it.
That would be my defined profit. My worst case scenario, my maximum loss would be 14 minus 13, $1 times 100.
Right.
So like $100. Am I right? I need to check that math, but minus the premium I received.
Right.
It's the difference times 100. That is your maximum loss because as soon as it goes below 13, my put kicks in.
Right.
And cancels out. So it's like in the difference. And that's what the whole, look, man, I mean, we're not doing this to play conservative. We want to go big, but like this guy that sort of advocates quite a conservative approach to options says that all he does is he primarily plays with credit spreads because although your profit is defined, your loss is as well.
Right.
And you can get high probability of low profit, so that's what I'm going to look into more detail later.
Then my question there is, say you have a 70% chance of profit and then like a 30% chance of loss. Do those more or less cancel each other out? For instance, if you do this thing 10 times, same value for everything or the same amount of profit or capped profit. So 70% of the time, this should work, right? And you should get the difference in profit. And 30% of the time, it should not, and you should suffer the loss. So let's say, for instance, in the 70% case, you're making $100. And in the loss case, you're making, 1,000 divided by 3. So you're losing $333 in that scenario. Does that not just cancel each other out over time? I mean, you get to zero over time, or am I wrong?
I don't know. That's a really great point. I didn't think about that. He didn't highlight that. You might be right.
Yeah, because 3 out of 10 times you're wrong, and that cancels out the 7 out of 10 times you're right. Um, is there really profit to be made? Or and maybe this is just where the intuition comes in. Like the market thinks that it is 7 out of 10 that you will win, and you strongly believe that the market's wrong. That this is actually you will win 80-90% of the time based on this, and then that's where you're able to win. Interesting, very very interesting.
I don't know. I might have to bust out my little notebook and check it out again.
Yeah, I would love to dive more into this, and kind of this is kind of you're becoming the house in a casino instead of being one of the players, is more or less what you're trying to do in this case. It's like little amounts of profit over longer periods of time, and you want to position yourself to always win.
Yeah, there's another concept that he talked about, which I thought was interesting. And he basically says that because, and I mentioned this in our previous call, but because almost always implied volatility is lower than actual volatility. And implied volatility is what gives the options a premium in pricing. He says that that's why in the long run it pays off to be a seller of options as opposed to a buyer of options.
Now, this is interesting because wouldn't implied volatility always be higher, or shouldn't it be higher than actual?
Yeah, but I guess like what you're getting is that, like in your instance, right? Like once the maybe you could argue that like as you get closer and closer to the expiration date, that implied volatility thing matters less and less, or maybe it like.
Yes, that's true.
I think you get a lot of option buyers whose options expire worthless, but they're paying a big premium for it at the beginning.
Yes. So actually, implied volatility, I think, matters more and more as you get closer to the end date. And what I mean is, if say you're 5% out of the money, if the implied volatility is 10%, that option is worth, say, 50% more than if the implied volatility was 5%.
Yeah.
Because the chance of you being in the money is like 50% more in that case. Well, maybe not. Maybe it's 25% more because it could go 10% up or down, right? Or if it's 100% implied volatility, then you would assume that option would be worth a lot more if you're only $5 out. Maybe I'm thinking wrong. I'm not sure. I'm going to have to read a little bit more about this and understand it more.
So that's what I'm thinking of doing. I only have like $70 cash left. I either do that or I just buy a crazy out of the money call like Tesla 1000 or something like that.
Are you able to buy calls like that with that much money? Just because I think that it would cost, well, okay. Yeah, I get what you're saying.
It's a factor of strike price and date, right? So you just try to massage that intersection where it costs, but the cost is like acceptable to you.
Yeah, makes sense. Though Tesla had a very nice day yesterday, which was.
I saw. I would have imagined that you have some Tesla calls, don't you?
I don't have any calls. I never even thought about getting Tesla calls because I thought that the price was too expensive. But now that I think about it, it's not. You're right, and I should have bought Tesla calls because I actually really believe that Tesla will do well over the coming months, given their agileness and their ability to continue producing well and performing well. They're just a young and agile company that gets stuff done.
Yeah.
So, no matter what industry they're in, I think they'll do well. Dang it, that's a really. Thank you for the insight, but I wish I had done it sooner. Because now at this price, I think they're at 650 today. It's quite a bit more than I'm comfortable with. Like, I think they will continue to go up and down 10% very easily, whereas or even 20%, like $100 or so. But I don't think over the next 3 months they'll go up $500, for instance. Maybe I'm wrong.
You don't think over the next 3 months they'll go what?
Over the next 3 months it would go up $500, for instance. Well, I guess now it's only $350, so it's in the realm of possibility to get to $1,000. But will it skyrocket like that? Given the current state of the world, I don't think so. Like, I don't think the volatility is going to be high enough, nor is the outlook for Tesla that good that it would warrant an extra $350, which is what, 33% or now 50% of their stock price jump.
We'll see. I may do that instead of selling my. I mean, it's so boring, man, to have defined profit.
Yeah.
So I might do that when I have hopefully a bit more cash. Right now, I just want to take like crazy bets. So we'll see. Yeah.
Well, I think what I'm going to do is do a crazy bet, but a little bit more informed.
Okay.
I'm going to sell everything that I have right now.
Everything to free up 700 cash.
Everything except for my May 15th puts.
Okay.
And then I'm going to make one bet.
All right.
And I'm not sure what that's going to be yet, but I'll make one bet.
I just find this very funny because that's not your normal personality type.
No,
Go all in on one thing.
It is not. But I'm really enjoying what we're doing so far, and let's see what happens.
All right. So you're gonna sell everything. You plan to. I look forward to tomorrow's call.
I really do too. We'll see if I'll see if I actually follow through and how much money I'm able to retrieve, because market open, I assume I'm going to be down another 50%.
Why? Is it green? How do you like? What is it? What do you think? How does it look?
I mean, everything I own is currently decreasing in value. And like today, for instance, everything decreased 50%. Without higher volatility, I assume everything that I own will decrease another 50% tomorrow, and another 50% the following day, until I'm at zero by the time the end of trading day 417, right? So we only have a couple of days.
Yeah, this lack of volatility is actually impacting all our option prices. Like
Yes.
my Zoom call too is being affected by sort of less implied volatility.
Yes. Cool. All
Yeah.
right. Till tomorrow then.
So thanks very much for watching Z and me today.
Don't forget to like this video, subscribe to our channel, and comment below with anything that you think we should be doing, or just to tell us how stupid we are, because definitely feeling stupid today.
What he said.
And that is our show. We'll see you tomorrow, and hopefully we stick to what we said we're going to do.